Markets around the world anticipate the Federal Reserve's decision to either increase the interest rates or keep them where they are. Today I'm going to discuss how the stock market is overvalued by at least 5 factors. You came here for the truth, so let me unveil that for you. I want to get into a whole bunch of topics today and show you how they are all interconnected. So the first dot is this right here. Everything is awesome. The US dollar index is up significantly over the past year. And why exactly is this the case? Well, it is quite obvious that when you're rating one currency, you're rating it against other currencies. So the euro has been doing terrible. I believe it's down to about 106 at the moment. And then you look at other currencies around the world have been declining recently. So that makes the US dollar look more attractive. But if you compare it to what I showed in my last video, and that is food prices, you will see that the dollar is losing value consistently. So I'm going to move on to this here. Move over dollar. Yuan may join IMF's SDR basket. This is out of the Asia Times, and they're talking about how this is going to rattle the international monetary order, and the yuan may never be the same. Citibank predicts in a recent report that the yuan will be accepted by the IMF's into its SDR. That's the IMF's, quote, supranational, remember that word, global currency, though the yuan isn't likely to be made fully convertible in when they vote on this. So a couple points that I want to touch on here. First of all, the fact that their full convertibility is going to take time. They have been lifting and relaxing this rise of the yuan, and it has been going steadily, and that is something that we've been seeing, we've been noting here. So very important to note that they are eventually could get into a situation of full convertibility, but don't think it's going to happen overnight. I also want to note the fact that they said that this is the supranational currency, and that is exactly what it is. Right now, it's just being used in certain situations with the IMF bailouts, but there's nothing stopping them from this being a backing to our currencies that we use worldwide. They could do this in order to get onto a new monetary system when this one fails. So very interesting information. I want to move on to this here. Out of Bloomberg, we're talking about the situation in China. Of course, all is not rosy. But before I get into it, just want to note that the prospects for the future of China are definitely very good, but they're not going to be without their crashes and collapses and corrections. So this right here is an article out of Bloomberg. China's steel and metals markets, a barometer of the world's second biggest economy, are a lot worse than you think. And this is according to a Bloomberg intelligence analyst who just completed a tour. Now you may think, who's this guy? What does he know? But he's not the only one that's saying this. If you just look around, look at the data, I've showed you many different charts showing you a decline in the economy in China. What he saw, idle cranes, empty construction sites, and half-finished abandoned buildings in several cities. Conversations with executive reinforced the gloomy outlook. So clearly they're having some of their own issues. Remember that China is primarily an exporting nation. There are many people moving from the rural areas into the big cities. That is very clear and obvious, but there are many more people that are suffering right now in China, and you know that all around the world, the global economy is suffering as well. So of course, you do not have the ability to export as much as you once did, and that really puts a damper on their economy. And just one last note, that China's metals demand is plummeting, and this is very important when you look at copper and other commodities. These are indicators of new buildings going up, new construction. Of course, new construction means things are booming, and even though you build entire subdivisions, entire cities, and you leave them empty, you know, eventually this catches up with you, and that's what's happening right now. Look at this, China non-performing loans. This has been increasing steadily over here since 2011, where they're showing with this arrow. And this is unbelievable to see how really steadily this has been going up. And this is very dangerous because they've been relaxing the rules in these recent months. So this could mean that they run into even more of a problem. All right. I'm going to move on to this here out of Bloomberg, talking about the U.S. states. They are not prepared at all for the coming financial crisis. In Moody's test, they said that a recession would open up a combined deficit of $64 billion, or 8.5% of the general fund expenses. And you could read the rest, but essentially what they said was the median number of days the states couldn't run on the reserves dropped to 22. Going to show you that these states don't have money to bail out their citizens or their own government, let's say, and they are unable to pay the bills when it really comes down to it. Look at Detroit, look at other cities, Flint, Michigan, for example. Other areas too are running into these deficits, and look, they don't have the reserves to really help themselves out. So they, of course, go to the federal government, and then we get the austerity measures that take place, and then you have all sorts of unbelievable things that happen. Let's move on to this here. Market pricing. The Fed is expected to hike in March 2016, and the ECB is expected to hike in December 2019. Essentially, what they're saying here is that times are changing, and the outlook here is definitely getting worse, not better. The analysts, the economists are suggesting that, look, the real outlook is not doing well. We're not seeing the growth that we had expected, of course, even though we said everything will get better in 2010 and 11 and 12 and 13 and 14. We're in 15 right now, 2015, and the economy still hasn't picked up at all. Yes, we have the stock market up. Yes, we have the US dollar up, but the economy is not. And of course, they can't raise the interest rates. It'll kill it. Here is the news of the day. The S&P 500 and the 5 measures of fair value. So we're looking at things like the current PE ratio, the Q ratio, and we're looking at corporate margins and other things right here. And in every single category, the S&P 500 is sharply above those. And this goes to show you how overvalued this S&P 500 really is. It is making new gains all the time, and this is very frightening when you look at it, because it has essentially gone up in a straight line ever since March of 2009, where we had the deepest point of the financial crisis. And of course, the Federal Reserve stepped in and said, look, we're bringing the interest rates all the way down to 0. We're going to print as much as it takes. Have no fear. We will restore the stock market. And essentially, they've done that. They have really done well at bringing the stock market up. But it has been at the sacrifice of the individuals, the citizens' ability to buy things simply because of the devaluation of the currency. Now, what exactly is going on here is nothing but another bubble that has been formed. When a bubble is formed, this is from my book here, when a bubble is formed in one asset class or another, it will pop when credit stops flowing in its direction. When the interest rates are at rock bottom and the prices are at record highs, consumer credit is going to be redlining. The bubble in that asset class will soon pop, having money flowing out into other sectors. And this is clearly evident with the tech bubble in 2000. Money left the stock market and piled into the housing market, and the housing market started booming, and then that began to crash, and the commodities boom really began to take off, and then all of that crashed, and then soon after, the equities markets began to rise. And we saw that continue on, in fact, until today. So eventually, this bubble is going to pop, and then something else is going to be built up into another bubble. What that is, I believe it will be real assets, things of real value, but it doesn't matter. I don't want to chase bubbles around. I want to hold onto real assets regardless, just for their security. And this is another thing here. The top 20% of earners pay 84% of the total income tax, and the bottom 20%, they get paid by Uncle Sam. One of the things I want to note from this article out of the Wall Street Journal is simply that they're suggesting and sort of implying that if you make, over 100,000, you're essentially part of the elite, part of the rich. But that's not the way it works. In fact, those households earning $250,000 are really not that wealthy. Yes, they are making more than the general population, but these are the people that are generally the small business owners who do, in fact, hire people and they get businesses going. But when you have something like an Obamacare, which forces them to anyone working full-time hours, or I believe it might be over 30 hours and over, need to supply their workers with Obamacare, what do? They begin to cut back on either employees or the hours. It hurts the real people, and this is going to show you that these numbers, you have to really look into the deeper part of them. Last but not least, I want to leave you with a quote that I'm sure you will enjoy. Facts do not cease to exist because they are ignored. And this is Aldous Huxley from 1927. I'm sure you know Aldous Huxley already. If you haven't read the book, at least read watch the movie of the Brave New World. Really excellent. And he's completely correct, because if you ignore all the facts, if you simply look at the US dollar index, if you simply look at the S&P 500, you get a completely different picture than if you're just open to all of the different indicators that are out there. I covered hundreds on this channel so far, and there are thousands out there that we need to look at. Some are positive, some are negative, but we need to look at as many as we possibly can. I do certainly show you as many as I can on the show, so I hope you appreciate that. If you do, please give me a thumbs up, and of course don't forget to share these videos. It's so crucial to do that every single time. I don't ask you every time, but certainly would appreciate that, because it gets the word out, not just for the Money GPS, but also for the truth, and that is obviously the most important thing. If you're not already, it is crucial to become an insider. The Insiders is where I give out all my best intel for free, and that is available at themoneygps.com. You just scroll down to the bottom and fill in your email address, and you get occasional emails from me with good, short, concise info.